Okay, let's unpack this SNDL. You might remember them as Sundial Growers, right? A big name back in the Canadian cannabis boom.
Definitely. Hard to miss.
But here's the kicker. SNDL is now Canada's largest private sector liquor and cannabis retailer.
It's a huge shift. Really makes you wonder how they pull that off.
Exactly. How did that happen? And, what does it mean for where they're headed? That's what we're diving into today. For you listening, if you want to get a handle on this quickly but thoroughly, this is your shortcut. We're breaking down SNDL's current spot, its potential, all based on a pretty deep analysis of recent data, reports, the works.
And what's striking really is the scale of this pivot. It's not just slapping on a new name.
No, definitely not.
They've fundamentally changed how they operate. From mostly growing cannabis to being this massive retailer in 2 regulated markets, plus that whole investment side.
Absolutely. Formerly Sundial Growers Inc., now SNDL Inc., to reflect that wider scope. So, as of our analysis date, April 29th, 2025, the share price was sitting at $1.47 USD.
Right, with a market cap around $378 million USD.
So our goal today, our mission, if you like, is to figure out if SNDL could be a value investment.
Makes sense.
We'll dig into the business itself, the management team, check the financial health, get a feel for market sentiment, see who actually owns the stock, and of course, look at the risks.
And it ties back to that bigger picture, doesn't it?
Yeah.
SNDL's story really mirrors how that whole Canadian cannabis market is, growing up, maturing.
It does.
They had to adapt. So this dive will show how well those adaptations have actually set them up for, the long term.
Okay, Chapter 1, let's understand the business. Fundamentally, SNDL is playing in diversified regulated products in Canada. Think stuff with rules attached.
Right, controlled substances, basically.
It boils down to 4 main areas: liquor retail, cannabis operations, and then their investments piece.
So how does the money flow in?
Primarily, their stores. The liquor stores, the cannabis dispensaries, that's the main engine.
Okay, retail folk.
Plus, they sell their own cannabis brands wholesale. And then there's income from those investments they make.
It's interesting, that deliberate split across liquor and cannabis, both regulated, but different markets. Maybe some stability there? Not all eggs in one basket?
Could be. Let's look closer at liquor retail. You've got banners like Wine and Beyond, Ace Liquor, Liquor Depot.
Familiar names, yeah, especially out west.
As of mid-March 2025, 165 locations, mostly Alberta. Pretty straightforward model. Selling wine, beer, spirits.
And having that established liquor network probably gave them a leg up, right?
Yeah.
Existing infrastructure, experience with regulated retail, something to build on for cannabis.
Good point. Now, cannabis retail. Banners like Value Buds, Spirit Leaf. They used to have Super Ret, too.
Right. Big network there now.
Yeah. Through a lot of acquisitions, they've become one of the biggest cannabis retail chains in Canada, selling adult-use products, accessories, the whole range.
And that growth, mostly acquisitions, you said.
Seems like it. Faster way to scale up than building from scratch, I suppose.
True. But then you've got the challenge of, actually integrating all those different businesses. It's not always smooth.
Definitely a challenge. Okay, cannabis operations. This is where they handle the plant itself. Cultivation, processing, making stuff.
The whole supply chain.
Exactly. Distribution, sales, both adult use and medical. They do flower, pre-rolls, vapes, and importantly, edibles.
Ah, the Indiva piece. Bang, chocolate.
That's the one. Plus concentrates. They've got a pretty big list of brands, too. Top Leaf, Palmetto versus Value Buds.
Bonejack, Grasslands, Pearls by Grun.
No Future Bang. A lot going on there.
That vertical integration, though, controlling it all, that offers potential pluses, right? Quality control, maybe cost savings, ability to innovate faster.
You'd think so. Then there's the investments part. This is SNDL putting capital to work strategically, mostly in the global cannabis space.
Like Sunstream Bancorp.
That's a key example, yeah. Direct and indirect investments.
So it's another layer. They're betting on the broader industry growth, not just their own direct operations.
Right. So you add it all up. Canada's largest private liquor and cannabis retailer. And with Indiva, the biggest infused edibles maker, too.
That scale is significant. Gives them leverage in buying, potential efficiencies, wider reach.
Absolutely. Scale in retail, especially regulated retail, is a big deal. Better buying power, maybe better logistics, more money for tech, marketing.
Makes sense.
Their value proposition, what they say they offer, is bringing people together through exceptional products and experiences.
Okay, marketing speak, but what's the substance?
Well, convenience and choice through that huge retail network. For cannabis, it's the vertical integration for quality and innovation.
Yeah.
And they're really pushing data insights now.
Ah, data analytics. That's becoming table stakes in retail, isn't it? Understanding the customer, optimizing ops, that could be a real edge if they do it well.
Could be. So, quick recap on how they make money. Selling liquor in stores, selling cannabis in stores, selling their own cannabis brands wholesale, and investment income. Pretty diverse.
Okay, got it. So what about the industries themselves? Cannabis and liquor in Canada.
Right, need that context. Let's start with cannabis. It's definitely maturing, after that initial legalization gold rush.
Growth slowing down a bit.
Estimates put 2025 revenue around $13 billion. Trends? Pre-rolls are getting huge, might even overtake flower this year.
Interesting shift.
But also price compression, still happening,
Yeah.
Squeezing margins.
Always a pressure point.
Regulation-wise, folks are hoping for some streamlining in 2025, could help. And then there's the global potential, especially the U.S. SNDL's investments there could pay off big time if U.S. federal reform happens.
Yeah, the U.S. is the elephant in the room for Canadian players. Maturing market means you need efficiency, strong brands, something different to stand out.
For sure. Now, liquor retail. Much more mature market, modest growth expected, maybe $28.3 billion in 2025.
Different dynamics there.
Yeah, trends are towards premium stuff, spirits, cocktails, ready to drink. Even non-alcoholic options are growing. At-home consumption, still strong. Interestingly, SNDL's liquor side saw some softness in 2024. But here's a potential curveball. Those 2025 U.S. tariffs and the Canadian counter tariffs.
Ah, the halting of provincial U.S. alcohol imports. That could really shake things up.
Big time. We'll come back to that. Competition-wise, both sectors are fragmented, lots of players. Cannabis has Tilray, formerly Canopy Growth, High Tide.
SNDL even has a stake in High Tide, right?
Yeah, passive stake. Liquor has regional chains, government stores in some places. Consolidation is happening, and SNDL has been a big part of that M&A activity.
That fragmented landscape means more consolidation is likely. Companies with scale, like SNDL, are positioned well for that.
Regulation is heavy everywhere. Federal, provincial for cannabis, mainly provincial for liquor. Those 2025 cannabis changes aim to simplify. U.S. prohibition is still the big backdrop for cannabis.
Navigating those rules is a constant cost, a constant challenge. Adaptability is key.
And getting in isn't easy. High barriers to entry in both. Licenses, big capital needs, compliance headaches, established competition.
Which protects the incumbents, like SNDL to some extent. Limits new threats popping up easily.
So long-term future for these industries seems like a solid yes. People have been consuming alcohol and cannabis for a long time. Demand isn't going away.
Agreed. Enduring consumer demand looks pretty stable for both.
Okay, let's talk competitive advantage. Their moat. How hard is it to copy what SNDL has built?
Need to look at brand strength, cost advantages, network effects, switching costs, unique assets.
Right. Brand strength. I'd say moderate. Tough to build rock-solid nationwide loyalty in these categories.
True. Lots of choice for consumers.
Cost advantages, maybe moderate potential there. Scale helps. Vertical integration in cannabis helps. Their gross margin improved, which is a good sign.
But that price compression in cannabis kind of limits how much advantage they can really get from cost savings alone.
Yeah. Network effects, not really applicable here. Switching costs, pretty low for consumers. People shop on price, convenience, selection mostly.
So with moderate brands and low switching costs, they constantly have to compete on price, selection, location, keep people coming back.
But they do have unique assets, that huge retail footprint, liquor and cannabis across Canada. That's big.
Definitely an asset.
The growing focus on data analytics, capabilities they bought, like Valens, Indiva, and maybe the most important, that debt-free balance sheet. Huge advantage.
Absolutely. Being debt-free in volatile sectors like these gives them so much flexibility and resilience.
So what makes them hard to replicate? It's that combination, I think. The scale in both retail sectors, built through M&A, being debt-free, and maybe that emerging data capability. It's a distinct mix.
It is. Hard to copy quickly. Okay, Chapter 2. Management. Always critical.
Let's evaluate the leadership. CEO Zachary George since early 2020. Background in alternative investments, turnarounds.
Which fits the SNDL story perfectly. It was a turnaround situation.
Absolutely. His track record, well, he restructured the debt, got them debt-free using equity raises, pivoted the strategy to this diversified retail investment model via all those acquisitions.
Right. Operationally, they hit record gross margins, got a positive free cash flow in FY24. So definite progress.
Yeah.
But Massive shareholder dilution along the way. The stock price is way down since the IPO, and that Zenadis acquisition came with baggage, like that product return lawsuit.
So the transformation was achieved, but it came at a significant cost to existing shareholders through dilution. That's a key trade-off.
Yeah. Crisis response. They navigated that near-death experience in 2020, handled the pandemic reasonably well, settled that IPO lawsuit for $7 million.
Suggests they can handle tough spots, manage financial distress, make strategic shifts when needed. Resolving the lawsuit removed an uncertainty, too.
Communication transparency. Seems okay. Investor website reports, webcasts, segment reporting. They reconcile non-IFRS numbers.
Standard stuff, obviously.
Regular SEC and CDR plus filings. Generally adequate, though maybe the investment arm could be a bit clearer sometimes.
Yeah, more detail there wouldn't hurt. But overall, seems reasonably transparent. Ethical reputation. That 2019 IPO disclosure issue with Zenabis, the settlement, that's the main historical mark.
Yeah, can't ignore that.
But current management talks a lot about integrity. Standard governance policies are in place now.
So, past issues acknowledged, current focus on doing things right.
So, the big question. Honest, capable, shareholder-oriented.
The $1 million question, or maybe the $378 million question here.
Honest. Seems reasonably so. They acknowledge the past issue. Capable. Demonstrated capability in restructuring, M&A, improving operations. Got an experienced team.
Okay. Shareholder-oriented. That's the tricky one.
It is. Positive FCF, margin improvements, the buyback program that points towards shareholder focus. But the historical dilution is huge. Executive pay seems high relative to performance and market cap, and almost no insider buying. That raises flags.
Yeah, the lack of skin in the game, buying shares with their own money. That's often a concern for value investors. It feels like the focus was maybe more on building the empire than immediate shareholder returns.
That's a fair assessment. Consistent shareholder returns aren't proven yet. Okay, capital allocation. How are they using their money?
Critical piece. Where does the cash go?
Investing in the core business. Closing the Olds facility to streamline growing, putting money into retail like the Rise Rewards loyalty program, integrating all those acquired companies. CapEx seems modest lately.
Makes sense. Optimizing what they have.
But M&A, that's been the cornerstone of growth, really built the company we see today.
Inner Spirit, Alcana, Velin, Zenabis, Nova, Indiva, those 1CM stores recently, a long list.
The focus seems clear. Canadian retail scale in liquor and cannabis, plus boosting cannabis capabilities like manufacturing, edibles. Strategic investments like Sunstream, High Tide Stake are part of it too. Aggressive M&A defined their path.
It absolutely transformed them. But again, success hinges on making all those pieces work together effectively. Integration is key.
They also started a share buyback program, authorized up to $100 million, been actively buying back shares recently too.
Usually a signal management thinks the stock is cheap. A potentially good use of capital, if true.
Dividends? None. Unlikely anytime soon, given the history of losses and focus on reinvesting.
Standard for a company in this phase. Growth focus.
Return on invested capital, ROIC. They don't report it explicitly, but given the losses, equity raises, acquisitions, goodwill, probably negative historically.
Yeah, very likely. Getting a positive ROIC on all that deployed capital is the big challenge ahead. Positive FCF is a good first step, though.
So are they using capital effectively for shareholders? Debatable, isn't it?
Definitely arguments both ways.
Or recapitalized the company, got scale, diversification, bought key capabilities, debt-free, doing buybacks now, hit positive FCF, targeting $100 FCF.
Against huge value destruction since IPO, still not profitable on a net basis, integration risks, likely poor historical ROIC, low insider ownership.
Exactly. They achieved the transformation, but they need sustained profit and positive ROIC to really prove the capital was used effectively. The buyback suggests current management believes it's good allocation now.
Right. The transformation is done. Now it's about delivering the results from that new structure. Consistent profit, positive ROIC. That's the proof needed. Buybacks show current confidence, at least.
All right, let's shift to Chapter 3, Financial Health. Looking at the numbers as of late April 2025, mostly based on FY 2024 results.
Okay, let's get into the balance sheet and income statement realities, foundational stuff.
Market cap around $378 million USD, PE ratio Not meaningful. Still losing money on a net basis, $94.8 million CAD loss in FY24.
Right. Negative earnings per share. Analysts expect losses for FY25 too, so profitability is still elusive on that GAAP net income line.
Revenue growth in FY24 was pretty modest, 1.3% year over year, hit $920.4 million CAD. Cannabis segments grew over 10%, but liquor retail actually shrank by about 4%.
So cannabis driving the slight growth, liquor lagging a bit.
But gotta remember the long-term picture. FY20 revenue was just $61 million CAD, so dramatic growth through the transformation. Analysts do expect more growth ahead.
Okay, so recent growth muted after that massive acquisition-fueled expansion. Profit margins for FY24.
Gross margin, 26.1%. That's a big jump from 20.9% the year before.
That's significant improvement. Why?
They say acquisitions helped, optimizing supply chains, and interestingly, data licensing revenue.
That data piece again. Okay, positive sign on gross margin. Operating margin.
Still negative. MAG at 11.3%, better than the NAG at 17.9% in FY23, but still an operating loss, mainly driven by losses in the investments and corporate segments, plus impairments.
So the core retail and cannabis ops might be doing better, but other segments and charges drag down the operating result. Net margin.
Also negative 10.45%. Again, an improvement from negative 19.4% the year before, but still a loss.
Okay, so margins improving across the board, but still solidly in the red on operating net levels. Debt to equity.
0. No conventional debt. Equity base over $1.1 billion CAD. Very strong there.
That's a huge plus. Major financial stability buffer, free cash flow.
This is the big positive news. Positive $8.9 million CAD in FY24. First full year positive. Big turnaround from a $60 million loss in FY23.
Wow, that's a key milestone.
Yeah.
They actually generated cash from the business.
Yeah, they hit their guidance. And that's despite the net loss, mainly thanks to non-cash charges like depreciation and managing working capital well. They're targeting a $100 million annual FCF within 3 years.
That positive FCF is crucial. Shows the core business can sustain itself and generate cash, even if accounting rules lead to a net loss. The $100 F target is ambitious, but shows focus.
And finally, price-to-book ratio, around 0.46, consistently trading way below the book value of its assets.
PB below 1 often suggests undervaluation, or maybe market worries about the quality earning power of those assets. Could be either.
So back to the key question. Profitable with a strong balance sheet. Balance sheet, definitely strong. Debt-free, lots of cash. Profitable, not yet on a GAAP net income basis. But positive FCF is a huge step towards it. The path is clearer, but not guaranteed.
Yeah, it's mixed. Great balance sheet providing safety. Positive FCF is vital progress. But that consistent net profit is still the missing piece investors are looking for.
How about financial stability? Earnings consistency over 5-10 years. Highly volatile. Consistently negative since the IPO in 2019.
Reflects the whole restructuring, dilution, M&A integration journey.
Recent trend FY23 versus FY24 shows improvement, narrowing losses. But the transformation makes it hard to see underlying trends clearly. Adjusted EBITDA has been positive, but GAAP net losses remain.
Stability really depends on this new diversified structure, delivering consistent results going forward. Dividend stability.
Not applicable. No dividend. Debt management. Excellent. No conventional debt.
Huge positive for stability. Working capital.
Looks strong. Current ratio over 5. Big cash balance, $218 million CAD. Positive operating cash flow in FY24.
Okay. Seems efficient there. Liquidity looks good.
So earnings, volatile, excessive debt. Earnings, yes, historically very volatile with losses. Excessive debt, no, currently debt-free. That lack of debt is a critical safety net.
Definitely. Provides breathing room.
Okay. Quite a bit covered there on the financials.
Yeah, a lot to digest. All right, we've hit the halfway point. When we come back, we'll tackle market sentiment, who owns SNDL, and a full SWOT analysis of the risks and opportunities. Sounds good. Sets us up to understand how the market views all this, who the stakeholders are, and what the future might hold, both good and bad.
Welcome back. We're diving deep into SNDL. We've covered the business, management, and financials. Now, Chapter 4. Market sentiment. What's the vibe out there about SNDL?
How the market feels, right? Always important. Collective expectations.
Well, it's certainly changed. Remember 2021 total meme stock frenzy?
Oh, yeah. Driven by retail hype more than anything else sometimes.
Now, the story is more complex. It's seen as this big turnaround play, diversified retail investments, but there's likely still skepticism lingering.
Understandable, given the history of losses, the dilution, the general cannabis sector volatility.
Definitely. But significant retail investor interest is still there. And they did that dual listing on the CSE in April 2025.
Right, to maybe broaden the base.
Yeah.
Easier for Canadians, maybe some U.S. exposure via Canada.
Should be the goal.
Yeah.
Didn't seem to move the needle much immediately, though. Overall, perception feels polarized. Some see deep value potential in this transformed company.
While others are probably worried about execution risk, can they actually pull off this complex strategy?
Exactly. What about analyst price targets?
Generally positive, but the range is pretty wide. Suggests analysts aren't all on the same page either.
What's the average target look like?
Around $3.57 USD for 1 year out. But you see lows around $3.03, highs up to $4.20. Some sources quote even higher. So a fair bit of uncertainty baked in.
Yeah. Consensus rating is usually hold or maybe buy, speculative buy. All those targets imply pretty significant upside from the current $1.47 price.
So the big gap between targets and the actual price, it suggests the market is demanding a higher risk premium, right? Or just plain skeptical. Common in cannabis stocks.
Very common. Value investors probably shouldn't put too much stock in those targets alone. Need your own analysis.
Always. Analyst targets are just one input. Any recent news affecting sentiment?
April 2025 had a few things. That CSE listing we mentioned. Launching the Rise Rewards loyalty program for Value Buds seems positive for cannabis retail.
Building customer loyalty. Smart move.
Announced buying more stores, those 1CM locations, continuing that consolidation play.
Sticking to the M&A strategy.
And they set their Q1 2025 earnings date for May 1st. That'll be key. Everyone watching if that positive FCF is sustainable. Plus, routine SEC filings, just keeping compliant.
So, steady execution on the strategy. Upcoming earnings are the next big checkpoint. Okay, what about short interest options activity? Any clues there?
As of mid-April, short interest was pretty low, actually, around 3.5 million shares, maybe 1.4% of the float, significantly down from mid-2024 levels.
Suggests less bearishness. Fewer people betting against it.
Seems like it. Options activity. Put-call ratio was below 1, meaning more call option interest than put interest, generally seen as a bit bullish.
Interesting. Any long-term bets?
Yeah, noticeable open interest in longer-dated options out to 2026, 2027, around strikes like one of all $52, $3. Some people making longer-term speculative plays, but implied volatility was still pretty high, around 58%. The market still expects the stock to bounce around quite a bit.
So maybe less outright bearishness, some bullish option bets, but still expecting a volatile ride. Makes sense for a turnaround story in this sector.
Yeah, fits the picture. Okay, Chapter 5, ownership structure. Who actually holds the stock?
Right. Who are the key stakeholders can tell you a lot about potential influences and stability.
Institutional ownership. The numbers vary a bit depending on the source, anywhere from 4% to maybe 19%. Recent filings suggest it's probably in the 15% to 19% range.
Okay, so not overwhelmingly high, but not insignificant either. Who are these institutions?
It's a mix. Some active managers like Canal Capital, various ETFs, cannabis focus, small cap, index funds, investment advisors, hedge funds, trading firms.
So some might be long-term holders, others might be more thematic or trading-oriented, less stable maybe?
Could be. Institutional trading can definitely add to volatility. What about insider holdings?
This is usually a key one for value folks.
Yeah, and it's very low. Some reports say less than 1%. Others, using a broader definition, might put it around 5%.
Really low.
Yeah.
Any buying or selling.
That's the notable thing. No reported open market purchases or sales by insiders in the last 12 months.
Despite the buyback program. Despite management saying it's undervalued. That's interesting.
It is. They get stock compensation, RSUs, and have ownership guidelines, but it seems they meet those mostly through grants, not buying shares themselves.
Oh.
Raises that alignment question again.
Definitely. Lack of skin in the game can be a red flag for some investors. Okay, ownership concentration.
Well, with institutional ownership around 15, 19%, and the top holders having decent chunks, there's some concentration there.
What the rest?
The vast majority, probably 80, 90%, is held by the public, retail investors. Reflects that meme stock history.
Right. High retail ownership often means more volatility, maybe a less stable base than heavy institutional ownership.
Probably true. And corporate governance impact.
How does this ownership structure affect how the companies run?
Well, they have standard stuff. Independent board, separate chair CEO, code of conduct. CEO talks integrity.
But that historical IPO lawsuit.
Right, that's part of the governance track record. And the potential weakness we keep circling back to. Low insider ownership plus high-ish executive pay. Does that really align management with long-term shareholders?
It's a valid concern. Standard policies are good, but alignment is crucial. Okay, let's pull it all together. Chapter 6, risk assessment. SWOT time.
Strengths, weaknesses, opportunities, threats. Let's summarize. Strengths.
Diversified. Cannabis and liquor retail, largest private retailer scale in Canada. That debt-free balance sheet, strong cash position, vertical integration in cannabis, experienced turnaround leadership, improving financials, positive FCF, better margins, and that growing data analytics capability.
Okay, solid list of strengths. Weaknesses.
History of net losses, can't ignore that. Acquisition integration risk, putting all those pieces together smoothly. Cannabis market pressures, competition, price drops, recent softness in the liquor segment, low insider ownership and those alignment concerns, and potential volatility from the investment portfolio.
Opportunities.
More market consolidation they could keep acquiring. U.S. market potential, if when reform happens. Finding synergies between their different segments. Growing that data licensing revenue. Potential benefits from Canadian regulatory streamlining for cannabis. Product innovation using tech they acquired. And, importantly, those Canadian counter tariffs on U.S. alcohol.
That tariff point is a big potential opportunity. Threats.
Intense competition in both liquor and cannabis. Unfavorable regulatory changes are always a risk. Continued cannabis price compression, shifting consumer tastes, a general macroeconomic downturn hurting spending, execution risk, can they actually deliver on the strategy, and broader tariff trade war escalation.
Okay, that covers the SWOT. Let's focus a bit more on those 2025 U.S. tariffs and Canadian counter tariffs. Direct impact on SNDL.
Seems minimal for their core Canadian operations, right? They mostly operate within Canada. Might ding their U.S. investments indirectly if the U.S. economy suffers, but...
But the indirect impact, the Canadian counter tariffs stopping U.S. alcohol imports, that's the potential game changer for their liquor retail side.
Huge opportunity there. Suddenly, a major source of competition for their liquor stores could just disappear or get much more expensive.
Exactly. Could mean more market share, higher sales, maybe even better margins for Wine and Beyond, Ace Liquor, etc. Unexpected potential tailwind.
But there's a flip side. A long trade dispute could hurt the overall Canadian economy, dampen consumer spending.
Which would hurt both their liquor and cannabis sales eventually. Could also slightly increase some supply chain costs, maybe.
True. So how does it affect the stock valuation?
Near-term uncertainty from trade wars could weigh on sentiment generally, but that specific liquor opportunity, that's a potential positive catalyst for their actual business results, and maybe the stock price follows.
Net impact depends on how bad the trade dispute gets versus how big that liquor opportunity proves to be. SNDL's Canada focus does insulate them from direct U.S. tariff hits, though.
Yeah, that diversification and Canada-centric operation helps there. All right, Chapter 7. Brief conclusion. Let's wrap this up.
So overall picture.
SNDL is transformed. Got scale, strong balance sheet, financials are improving, positive FCF is key. But risks remain. Consistent profit isn't there yet. Market sentiment is mixed. Shareholder alignment is a question mark.
And it trades below book value. Potential value play if the turnaround fully succeeds.
Right. And that U.S. alcohol counter-tariff situation throws a fascinating, potentially significant new opportunity into the mix, especially for the liquor side.
It really does. So the critical question for an investor becomes,
is SNDL a deep value stock ready to rebound significantly? Or is it still a high-risk turnaround with too many hurdles left to clear?
That's the decision point. Our analysis shows progress, but also clear risks and uncertainties still in play.
Which brings us to the end hook reveal. We started asking how Sundial Growers became this massive liquor and cannabis retailer, SNDL, and what it means.
And the answer is complex.
It is. They've made huge strides in scale, financial health, positive FCF is a big win. But that journey to consistent profit and creating real, sustained shareholder value, it's still ongoing.
Clearly not finished yet.
And those Canadian counter tariffs on U.S. alcohol. That adds this really intriguing, potentially major new twist to the story, especially for the liquor business. Definitely something you need to consider when thinking about SNDL's future.
Yeah, that external factor could significantly impact one of their core segments.
Yeah.
Something to watch very closely.
If you found this deep dive useful and you want more analysis of public companies, definitely subscribe to the Stock Analytics AI YouTube channel.
We try to provide valuable insights to help you stay informed. You can find links to all the sources we use for today's analysis down in the description.
And just a final reminder, this analysis is based on public info as of April 29th, 2025. It's our analysis, not financial advice.
Absolutely. Always do your own thorough research. Maybe talk to a financial advisor before making any investment decisions. We're analyzing the info, not endorsing any specific viewpoints found in it.
Thanks for tuning into the deep dive.
Thank you for joining us.